Hey everyone, welcome back to the channel. I am a psychology researcher at Overtrading channel. Today, we are going to look at the 5 main reasons that may be causing consecutive losses in your trading. Let's get right into it. It's incredibly frustrating, I know, to see your account balance dwindle despite your best efforts. You're putting in the time, you're analyzing the charts, but somehow, those wins just seem to slip through your fingers, replaced by a string of red. More often than not, it's not about a flawed market or bad luck, it's about subtle yet incredibly destructive habits that creep into our trading routines. These are the mistakes that can silently sabotage your progress and prevent you from achieving consistent profitability. The good news is that these mistakes are identifiable, and more importantly, they are correctable. By shining a light on these common pitfalls, you can start to recognize them in your own trading, take proactive steps to eliminate them, and begin to build a much stronger, more resilient trading foundation. Think of this as a diagnostic checkup for your trading strategy. We're going to pinpoint those areas that might be causing you to bleed capital unnecessarily, so you can patch them up and get back on the path to growth. It's about making those incremental changes that compound over time into significant improvements. In this video, we're going to break down 5 of the most common and detrimental trading mistakes I see people make. Mistakes that I've even been guilty of myself in the past. We'll explore why they happen, how they impact your bottom line, and most importantly, what you can do to avoid them moving forward. From impatience and strategy hopping to letting emotions like greed and anger dictate your decisions, we're covering critical ground. So, grab a notepad, get comfortable, and let's explore how you can transform your trading by avoiding these crucial errors. Alright, kicking things off with mistake number 1, not waiting for a proper confirmed trading signal. This is a huge one, folks. You see the market moving, maybe it's approaching a level you've been watching, and that fear of missing out, FOMO, starts to creep in. You think, if I don't get in now, I'll miss the entire move. So, instead of waiting for your specific, predefined criteria to be met, whether that's a candlestick pattern, an indicator crossover, or a break of a key level, you jump in prematurely. Your strategy might have clear rules, but in the heat of the moment, patience goes out the window. When you start considering multiple ways to enter a trade simultaneously, without waiting for that one clear signal your strategy dictates, your mind just gets overwhelmed. You might see a hint of a bullish sign here, a slightly bearish indication there, and you try to piece them together into a justification for entering. This mental gymnastics leads to confusion, and often, you fall into a psychological trap. You're not trading based on a high probability setup anymore, you're trading based on hope or anxiety. This lack of clarity is a recipe for disaster because your decision isn't rooted in a solid, repeatable process. The consequence of this impatience is almost always a poorly timed entry. You might get in too early, only to see the market reverse and hit your stop loss. Or you enter based on a weak signal, and the trade just chops around, tying up your capital and mental energy. Waiting for a clear, confirmed signal according to your well-tested strategy isn't about being slow, it's about being disciplined and selective. The market will always present opportunities, but the high-quality ones are worth waiting for. Remember, a good trader is often a patient trader. Next up, mistake number 2, not sticking to your trading strategy. You've spent time developing or learning a strategy, you've hopefully back-tested it, and you know the rules. But then, a few losses happen, or you see someone else having success with a different approach, and doubt starts to set in. Instead of trusting the process and the statistical edge your strategy is supposed to provide over time, you start to tweak things on the fly, or worse, abandon it altogether for the next shiny object. This constant strategy hopping is a major roadblock to consistency. When you don't stick to your strategy, what often happens is you try to justify your lack of adherence by making repeated, impulsive entries or by closing trades prematurely, not according to your plan's exit rules. For example, your strategy says to wait for a specific setup, but you see a good enough setup and take it. Or your strategy dictates a certain stop loss and take profit level, but you get nervous and close the trade for a small gain, missing out on a larger potential profit that your strategy was designed to capture. These deviations make it impossible to know if your strategy actually works. The core issue here is a lack of discipline and trust in your plan. Every time you deviate, you're essentially trading without a map. You can't properly analyze your results because you're not following a consistent set of rules. Are the losses due to a bad strategy or bad execution of a good strategy? You'll never know if you're always changing the goalposts. The key is to commit to a strategy for a significant period, trade it with discipline and meticulously record your results. Only then can you make informed decisions about whether the strategy itself needs adjustment, or if it's your adherence that's the problem. Mistake number 3 is a particularly insidious one. Moving your stop loss and take profit levels mid-trade, especially based on the performance of other open trades or pure emotion. Your stop loss is there for a critical reason: to protect your capital and define the maximum risk you're willing to take on a single trade. Your take profit is set based on your analysis of where the market is likely to go, offering a reasonable reward for the risk taken. These levels should be determined you enter the trade based on objective market analysis, not on how you feel once the trade is live. But what happens? A trade starts moving against you, approaching your stop loss. Panic sets in. You think, oh, it's just a little pullback, it'll turn around, and you drag that stop loss further away, increasing your potential loss beyond what you initially deemed acceptable. Or, conversely, a trade is doing well, but another one of your trades just hit its stop. So, to make up for that loss, you move the take profit on your winning trade further out, hoping for a bigger win, even if the market structure doesn't support it. This is letting one trade's outcome irrationally influence another. This habit of shifting your goalpost completely undermines your risk management and your trade plan. Moving your stop loss because you can't accept a loss is a classic way to turn a small, manageable loss into a catastrophic one. Moving your take profit based on greed or the outcome of unrelated trades means you're no longer trading your plan, you're gambling. The predefined stop and target are part of the statistical edge of your strategy. When you interfere with them based on emotion or arbitrary reasons, you destroy that edge. Set them, and unless there's a very valid strategy-based reason to adjust, like a trailing stop in a strong trend, let them be. Greed. Mistake number 4, and a powerful emotion that can derail even the most disciplined trader if you're not careful. In trading, greed often manifests as an unwillingness to take profits when they are available according to your plan, always holding out for that little bit extra, even when the risk of doing so outweighs the potential reward. It's the voice that whispers, "This is going to be a home run, don't sell yet," even when your system is screaming, "Take profits." This is especially common when you have a multi-tiered take profit strategy. Let's say your strategy involves taking partial profits at TP1, more at TP2, and letting a small runner aim for TP3. The mistake here is when you consistently see the market hit your TP2 level, a perfectly good and pre-planned profit target, but you get greedy. You decide not to close out the position or a significant part of it, thinking, why settle for TP2 when TP3 could be just around the corner? You ignore the plan, fueled by the desire for a bigger win, often without any new market information to justify holding for that higher target. The painful outcome of this greed-driven decision is watching a perfectly profitable trade, one that hit your objective, reverse and turn into a smaller win, a break-even trade, or even a loss. The frustration is immense. You had the profit in your grasp, your plan told you to take it, but greed convinced you to hold on. Learning to be satisfied with your planned profits, especially at key levels like a TP2, is crucial. Banking consistent planned wins is far more sustainable than always chasing the grand slam and often coming up empty-handed. Discipline over greed every single time. Finally, mistake number 5. Overtrading or manipulating your trading volume, especially after making one of the previous mistakes or experiencing a string of losses. This is often referred to as revenge trading. You've taken a hit, maybe you jumped the gun, didn't stick to your strategy, moved your stop, or got greedy and watched a winner turn sour. Now you're angry, frustrated, and you feel this intense pressure to make back those losses. Your rational mind takes a back seat, and emotion takes the wheel. This emotional state leads to terrible decision-making. You might start seeing setups that aren't really there, forcing trades that don't meet your criteria, that's overtrading. Or, you might decide to drastically increase your position size on the next trade, thinking a quick win will wipe out the previous loss. This is manipulating your volume recklessly. You're no longer trading your plan. You're gambling in an attempt to feel better, or to get your account balance back to where it was, fast. This is like trying to put out a fire with gasoline. The almost inevitable consequence of revenge trading and overtrading is digging yourself into an even deeper hole. These emotionally charged trades are usually low probability and carry excessive risk. You compound your losses, erode your confidence further, and can even blow up your account if you're not careful. When you experience losses or make a mistake, the best thing to do is often to step away from the charts. Take a break, clear your head, analyze what went wrong objectively, and only return to trading when you're calm and ready to execute your plan with discipline. Don't let one mistake snowball into a disaster. And there you have it, folks. If you recognize any of these 5 habits, not waiting for a signal, not sticking to your strategy, moving your stops and targets, letting greed take over, or overtrading after mistakes, in your own trading, it's time to make some changes. Acknowledging these tendencies is the absolute first step towards building a more profitable and sustainable trading career. It's not about being perfect from day one, but about continuous improvement and learning from every experience, good or bad. These aren't just abstract concepts, they are concrete behaviors that directly impact your P&L. The journey to consistent trading success is paved with discipline, self-awareness, and a commitment to your plan. Each of these mistakes we discussed today chips away at that foundation. But by consciously working to eliminate them, you reinforce your strategy, protect your capital, and allow your edge to play out over time. Start by focusing on one area you struggle with, implement changes, and track your progress. Remember, small, consistent improvements compound significantly in the long run. It's about playing the long game, not chasing quick fixes. I genuinely hope this breakdown helps you identify areas for improvement in your own trading. The market will always be there, offering opportunities. Your job is to be prepared, disciplined, and to execute your plan flawlessly. Don't forget to like this video if you found it helpful, subscribe for more trading tips and strategies, and hit that bell icon so you don't miss out on future content. Thanks for watching, and I'll see you in the next video.
Follow us in NeuroTrade channel.